Hey everyone, welcome to MAAF Unit 4, Performance, Measurement and Management. Now within this chapter we're going to be going through 4 subtopics. So number 1 is outline a framework for appropriate performance evaluation. So that's when you just go back and assess performance. Number 2, develop appropriate key performance indicators, also known as KPIs, or the metrics that you're actually going to be tracking. Number 3, develop and apply the balanced scorecard performance management model. So we'll talk about this balanced scorecard a little bit later. It is something that comes up in exams, so it's important to know that one. Number 4, explain the impact of remuneration packages and performance measurement on the behavior, motivation, and decision making. And this is just talking about the psychology between, bonuses, for example, certain salary levels and so forth. What is the impact on that on behavior and motivation? For example, if you've got a staff member with a bonus to hit a profit in one period, they might want to kitchen sink or pile up all the profit in one period and make it not as good as in the second one, because in their position they get a higher bonus than if they had just done it organically. So that's just an example. So let's deep dive into this, number 1, which is the framework for an appropriate performance evaluation system. Okay, so first of all, let's talk about performance evaluation systems, what they are, what they do. So, performance evaluation systems, A, communicate what is important to the organization and what the organizational expectations are. B, provide feedback on performance levels. C, allow for an assessment to be made as to whether objectives are being met. So, to optimize achievement of the organization's strategic objectives needs to align the employee's personal goals with that of the organization. Let's discuss what makes a performance evaluation system effective. So it should have these attributes. So employees should understand the system. Employees can clearly drive actual performance. Performance targets should be realistic and achievable. The standard of performance expected is clearly communicated to employees. The reward for meeting performance targets is understood by employees. And these systems help management to communicate priorities, provide feedback on progress against targets, assess the performance of employees, managers, and organizational business units. Now, if you're like me and you're reading through this, especially with the MAAF subject in particular, there's a whole bunch of words, and they make sense individually, but when you ask the question, what are they really talking about here? Like, what is a performance evaluation system? I think they don't explain it very well, because the way I like to learn is I like to correlate it to a real thing in the workplace. And if I'm going, okay, that's what they're talking about, it makes me understand it a whole lot better. So what are some examples of performance evaluation systems in the workplace? Well, the most obvious one that people could relate to is the annual appraisal system that people go through in the workplace, right? So let's apply this to what the notes are saying. So the purpose of the performance evaluation system is to communicate what's important to the organization, what the organizational sections are. So, for example, if you're working at a Big 4 company, let's say PwC. PwC wants its employees to perform at a high level of output. They want to have high level employee satisfaction. They want their staff to be working at high efficiency levels, so working a lot of billable hours. So all of these things are going to be built in this performance evaluation system. So each year you're going to go through and you're going to go, okay, what's your, billable hours? How provide pieces of feedback from other staff and some customers as well. That way we can actually assess whether you've been achieving the things that are important to the organization, i.e. efficiency, billable hours, client satisfaction. What else? So provide feedback on performance levels. So you get the opportunities with your manager to, they'll talk through what your positive and negative feedback points and improvement points are. And then C, allow for an assessment to be made as to whether objectives are being met. So, of course, if you're at PwC or KPMG or Deloitte or wherever it is, you, after the end of your assessment period, you're going to receive a score out of 5. Maybe it's in different areas, maybe it's just one score. And that's going to tell you whether you're meeting your objectives, exceeding your objectives, or not meeting your objectives. Okay? But that's just one example of performance evaluation, right? You might also be working in a commercial place, and maybe it's not to do with employees, maybe it's to do with achieving a certain target. Maybe you're acquiring a really big company and the company wants to integrate the company well. Maybe it wants to achieve certain growth targets, and maybe there's just a system put in place, integration plan to actually achieve those things. The integration plan in that case would be the performance evaluation system. Another example could be a bonus system where staff need to achieve a certain goal and they're being rewarded for that. So this is what I'm just doing. As I'm reading through this, I'm thinking, what in the workplace is the most relatable thing? Because at least to me, that in my learning style, that's what helps me understand it. So let's go through this and discuss what are the stages of a performance evaluation system. And in each of these, what I'll do is I'll correlate this back to a review process, relating it back to, say, for example, PwC's annual employee review process. So first stage of a performance evaluation system is objectives. So each needs goals and objectives. So they're developed during the strategy and planning process, and they should reflect the factors which are considered critical to the organization. So for example, with PwC, I mentioned the fact that they want to achieve high-level billable hours and high-level customer feedback. Next is measurement, in brackets KPIs. So these are key performance indicators. So the purpose of key performance measures are to determine how effectively a goal or objective has been achieved, and it must be quantifiable. So there must be data, and you need to be able to precisely measure how success has been achieved. So for example, with the objectives, we said before we want staff to have a high level of billable hours. Well, the PwC is going to pull out your timesheet and say, okay, the average billable hour percentage per week is 80%. Now your target, actually that's the next step, so I won't talk too much about that, but you need to have a way of measuring it. Another way, for example, for client satisfaction is that you need a certain number of client feedback. So maybe you've got a client feedback form where they rank you and provide some, information, etc. So stage 3 is targets. So this is where PwC says, okay, we know what the KPI is. We want to achieve this level. So we want to achieve a level of 75% billable hours each week. So what they'll do later is they'll measure the actual KPI, the actual data point, versus the target, and then make an assessment based on that. Now the final one is, well actually there's 2 more here, but then there's initiatives, which is how do you actually go and take action to achieve those targets, and maybe that's each month reminding staff what their percentage is and just allowing them an opportunity to catch up to that target. And then finally, which is down here on the next page, it is actually part of the same thing, it's just cut off for printing, is performance evaluation and feedback. So this is actually when you get to the end of the year, you sit down with your manager and you discuss through it and say, okay, you've had a 75% billing hours. This is right on target. Therefore, we're going to assign you a 3 out of 5 score, for example. So this is where you measure whether the desired level of performance is achieved relative to the target. You discuss and analyze the reasons for the gap between the actual and expected performance. You take actions to address performance issues. Maybe it's putting them on a performance plan. Maybe it's explaining them the situation, how to actually do it properly. Maybe it's giving them more clients. And so forth. So here we have a diagram here, which kind of visually summarizes what we discussed about above. So you define the objectives, you set the performance measurements, i.e. the KPIs, you set the targets, then you evaluate, and so forth. Okay, so the next one that we're going to be talking about is develop appropriate key performance indicators. So if you remember from the very top of the page, this is the second subtopic, KPIs. So we kind of mentioned a little bit above here with set performance measurements. This is more of a deep dive into that. So a KPI is a key performance indicator. It's a measure that a business uses to track performance and measure outcomes. It's designed to focus individuals and teams on improving their performance. So measures performance against criteria considered important in achieving desired outcomes. So KPIs can be used to ensure alignment with strategic objectives, analyze performance to decide what actions to take in order to achieve targets, attain operational goals, analyze performance over a period of time to identify trends. So it's really important that it's quantifiable. So there needs to be some data behind it. And once you have data behind it, it allows you to actually track it over time and identify trends. And it also allows you to set targets in relation to that. Because if we just say we want to, make more money, right? How do you do that? That's not specific. It doesn't give you any data set to be able to measure it and so forth. So that's why KPIs are quite specific. They're data driven. And as well as these other points that they align with objectives, they allow you to set targets and so forth. So developing appropriate KPIs. So there's 2 main factors to consider prior to developing KPIs. So number 1, you need to understand what is being measured. So you need to take into account an organization's strategic and operational goals. Number 2, you need to ensure what is being measured is useful and quantifiable in terms of determining whether an objective has been achieved. KPIs. So when developing KPIs, ensure they are linked to critical success factors and or the drivers of organizational performances. So KPIs should have the following characteristics. Number one, they should be specific to the organization. Even direct competitors should have a different list of KPIs. So for example, PwC should have a different list of key performance indicators to KPMG. The reason is PwC might have, even though it's the same business, does the same thing, it might have very slightly different objectives. For example, KPMG might be looking to expand out into Western Sydney, might be looking to achieve an office, and to do that, to set those goals, they have to set, they've only got their own internal budget to achieve those goals, so each staff must have their own, certain billable hours. It might be to hire a certain number of partners out there or in certain industries, where PwC might be expanding into acquisitions and consulting and cutting down its audit division. So maybe its KPIs are more about hiring a certain number of partners in a certain industry, and so forth. So even though they're the same company, they're going to have slightly different KPIs. So KPIs should be specific to a scenario or set of circumstances. They shouldn't just be broad. For example, make more money. It should be billable hours this week. So whenever doing MAAF in the subject, whenever we're answering a question, we need to be really specific. When we're coming up with a KPI in an exam question, this is a very common situation, is you don't just say billable hours, right? You say X number of billable hours by X employee in this week over this year. So you have to be really, really specific. And this is where SMART comes in down here. And, you might skip over this in your notes and say, I already know about SMART, that's kind of obvious. But in reality, it's quite important to the question, because to get full marks in a MAAF exam in your answer, your response needs to cover each of these. And the markers will actually check this against it. Are they saying, is your answer specific? Is your answer measurable? Is your answer action-oriented? Is your answer realistic? Is your answer time-bound? So let's go through what SMART means, if you're not sure what it is. And then we'll go through some examples from a past exam very quickly to kind of see how this plays into an exam question. Now, I don't normally do that. I usually save that for the exam videos, which you can watch above. But I wanted to just draw this to attention because I really want you to understand this concept, this principle of whenever you're writing a response is being super specific, super measurable, super action-oriented, actually following this as a guideline. So let's go through each of these first. So specific means clearly defined. It means you're not saying something generic and iffy, and you need to be very precise in your wording. You need to confirm the strategic objectives or critical success factors and doesn't have multiple variables. It's just one thing, right? You don't say, achieve billing hours and achieve this and achieve that. You're saying one thing. Next is measurable. So it must be measurable, achieved in a timely and efficient manner. Assess not only whether a goal can be measured, but also whether it's practical and cost-effective to gather the information for the KPIs. So this is an interesting point, cost-effective. So the first thing is there a KPI for it? So with, making more money is too generic. But if we're saying billing hours per week, that's an exact data point that we can take. But also, if we're going to, this is a really interesting point. If we're going to say in our response, do a data census for every single Australian or every single, employee in Australia. Whilst, yes, this is specific, it is measurable, it's not actually cost-effective or practical. So interestingly enough, even though it sounds like a right answer, if you write something like that in an exam, you actually might not get a mark for it. And the reason is, you're looking for a solution. Well, the CA is looking for you to come up with solutions that if you went into a job as soon as you finish your CA, that the solution would also make sense in that job, right? Because if you think about the company you work for, if you went into a meeting and proposed doing something which is going to cost millions of dollars or would take years and years, or even with hundreds of staff, you wouldn't be able to achieve it. Like, for example, the census of all Australian, you're going to get laughed out of the meeting, right? So if it's not going to work in the workplace, why would it work in the exam? I guess that's the logic behind this. All right, next is action-oriented. So it needs to inspire an action or behavior and consider whether an action can be undertaken to improve the KPI. So is it something that you can actually control with actions? With billable hours, for example. Well, yes, you can. You can go and charge more hours. You can find new clients. You can ask partners for a new work if you don't have a customer or a client. So yes, you can actually inspire an action from that. Realistic target needs to be set. Okay, so the target of, let's say, 75% billable hours is realistic. But if you said 120%, that's not realistic. You wouldn't get a mark for that. And then finally, time bound. So you need to assign a time to your KPI. And this is one that a lot of people miss. So for example, the billable hours reference, which I keep on bringing up. If you're in an exam question and you say, improve billable hours to 75%, unfortunately, even though in the workplace that might be a good answer, you need to also assign a time-bound answer. So you need to say, achieve 75% billable hours per year. Now, the reason that we need to include a time period as well is number one, it teaches you to be more specific. Number two, if you're putting in a time period, it actually allows you to measure that over time. For example, 2020, 2019, 2018, you can actually see how that's changed over time. If you don't include the time, it's indicating that you're not measuring it in those time periods. And, it could mean, is it perpetual? Is it your average over the lifetime? So it's important to be specific in math. All right, so now that we understand what SMART means, maybe let's go through some examples in past exams. And actually, this might be useful as well. This is an extract from the CSG, and this gives you some advice as to things to watch out for when you're developing a KPI. So the first thing that it's mentioning is trends or variances. And what this is saying is, it's trying to explain the difference between a trend, which is many data points over time, versus a single data point. So here it's saying an example of a KPI, which is a trend, is an increase in sales revenue per month. So in other words, increase in sales revenue per month. So you know that there's an increase in sales revenue per month because you've got two data points there. You're saying that this data point is higher than this data point. However, it's saying a better measure would be sales revenue per month. Now, most people reading this will say, what's the difference between the two? They look exactly the same to me. Well, it's this increase in sales per month versus sales revenue per month. Sales revenue per month is a single data point. For example, the sales revenue in September is $10,000. Now, this is the results gathered from this measure could be used in a number of ways, including comparison against a target, against a budget, against a prior year, or against a trend over time. Whereas if you're just saying a trend, increase in sales revenue per month, you're only comparing against one, you're limiting your availability of comparison points. So, as I mentioned before, the sales revenue per month is a single data point. It can be captured just once, but it can be used to analyze performance in a number of ways. Therefore, it's a better response than the trend. That's a tricky one to kind of understand. Okay, so the next one is percentage changes. So this is fairly similar to the first one, where it's saying percentage change in temporary staff cost per month is very similar to the one above. Because you're saying percentage change, you're using two data points, right? So you're locking in two data points. You're locking in this month or last month, or you're locking in, this month versus this year versus last year, and so forth. The CSG is saying it's much better to use an absolute or a single data point where possible. For example, dollar cost of temporary staff per month, because then once you have that, then you can compare that against anything you want. You can compare it against last year, you can compare it against budget, target, whatever you want. So I guess the common theme with all these points is it's better to not lock yourself into two different data points, but to lock yourself into a single data point, and then you can actually make trends out of it or compare it to whatever you want. Similar to the last point, they're all the same theme. Where you're saying versus budget per month is actually a variance. So while this could be a useful comparison point to make, it's using it as a measure eliminates the ability to assess it against other targets. So it's basically don't lock yourself into a certain thing if possible. Try and just choose a single data point, and then you can compare it to anything you want. All right, so let's pull up some exam papers. Okay, what about this one? So this is from the MAAF 319 main exam. So question 1, part B, says required. Part B, develop two non-financial key performance indicators that would measure the operational performance of the proposed Manfield operations. Now I'm just going to look at the answers, main 3-1 main exam solutions. And let's just have a look at what they've written. Part B. Okay, so let's have a look here. So develop two non-financial, so it doesn't have numbers in it, it's more like qualitative and operational KPIs that would measure the operational performance of the proposed Manforce operations. Okay, obviously you haven't read the question, but that's okay. We can still analyze these KPIs. So number of passengers transported, trips per month. Now see how it's not saying change in number of passengers transported. It's just locking in a single data point. Percentage of on-time arrivals to collect passengers per month. Now you might be saying, oh, but they've used percentage. Well, that's still okay because percentage is still a single data point. It would be an issue if they said change in percentage of on-time arrivals to collect passengers per month. Okay, so let's bring up our smart over here and make sure that they've actually achieved all of these. So first thing, specific. Number of passengers transported trips per month. That's pretty specific to me. And they haven't made it into multiple different variables. They've got a single variable. It's just passengers. Next is measurable. Well, they can get the data for this and they can do it in a cost-effective way. So number of passengers transported, they'd have the records for that in the system. That's fine. And they can just pull that data out and it's going to be cost-effective. Next is action-oriented. So it's inspiring an action in that you're measuring the number of passengers or extracting the data from your system to get that data. Realistic. Is it realistic? Well, yes, I kind of touched on this before about the cost efficiency. Well, it's also realistic. If they've got the data set in their system, they could pull that relatively easily. And then time bound. Yes, they've got this. See how they've got per month? Now, a lot of people miss this in their exam and they miss out on the whole mark because they haven't got this time bound section of it. So you need a per something, per year, per month, per day, whatever it is. I probably wouldn't do per day because it's probably not that realistic as a data point. Per month is probably the best one, but it really depends on what kind of data you're pulling. Okay, hopefully that all made sense. We'll go back to our exam paper, our notes now. Okay, so let's talk about categorizing KPIs, which is perfect timing because we just focused on a non-financial KPI. So there's two categories here. There's financial measures. So this is usually a dollar amount, but it could also be a certain data point. Or it could be non-financial measures. So we talked about a bunch of those. So passenger numbers is one, return passengers is another. And this is not usually expressed as a dollar. It's expressed as a number, like number of passengers. So it'd be 1, 2, 3, 4, so 5, 6. They've also got here, you can have a mix of them. But generally it's either going to fall into one or the other, and the question will specify either financial or non-financial most of the time. So make sure that you actually pull the one for the right category, and if it asks for a non-financial, you don't use a financial one. Otherwise, you won't get a mark for the question. Okay, next is short-term versus long-term. So it's also important to consider whether it's a short-term or a long-term strategy. So short-term measures usually are straightforward to identify and develop, whereas long-term measures tend to be more qualitative measures. But ultimately impact long-term profitability. We've also got the operational versus strategic results split. So if it's strategic, it's more about where is the organization heading, and it's usually a direction set by senior management. Whereas if it's operational, it's more on the day-to-day or month-to-month, operations of business. Is it functioning in an efficient, effective way? And this is a means of checking whether, because operational on a day-to-day, adding up over time equals whether you're achieving your strategy. So whether or not your operational means are heading in the right direction to achieve your strategy. And then finally, lag versus lead indicators. So if it's lagging, it reflects past events and performances. It tends to be short-term and for the prior periods. If it's leading, it's focusing on measures that provide a current indication of future performance. Okay, so now we're up to the third subtopic, which is the balanced scorecard. And again, this is something, so KPIs and balanced scorecard are things that come up in exams quite a lot. So again, it's similar to the SMART KPIs. It's also important to understand the balanced scorecard. So what does it do? Well, it's a tool and it provides a framework for developing financial and non-financial measures to monitor the achievement of an organization's strategic objectives. So it measures the operational organization performance against 4 perspectives of the organizational strategy. So each of the perspectives contains a number of measures which are interrelated by cause and effect relationships. So measures are expressed in the form of SMART KPIs, financial and non-financial measures, short-term and long-term focused measures, lead and lag measures. So the 4 buckets that you, as a company, would use to measure your organizational performance are these: financial, customer, internal process, and learning and growth. Now, this is a methodology that was created by Kaplan, who's another similar guy to Porter, and that he's released a lot of valuable literacy on management accounting. So they've deemed that these are the 4 lenses that you should view your business that are the most important for the business to achieve its overall organizational strategy. For example, organizational strategy might be to, be the market leader in whatever industry you're in, right? To be a market leader, number 1, you need to be a profitable company, right? Because if you don't have profit, then you don't have a business. You need to have customers with loyalty and happy, because if you don't have happy, loyal customers, then they're not going to come back, they're not going to refer their friends, you're not going to get that revenue growth, right? So they're all interconnected, these, because that's going to lend into financial, and your financial is going to lend into your customer. Internal process, right? So how well can you actually achieve those outcomes with your internal team and resources? Your processes and systems and teams, because, if you don't have a good team to drive it, right, it's not going to achieve itself. Your customers aren't going to be happy by themselves. You need a call center, right? To get new customers, you need marketing, right? To have a good product, you need a good design team and an operational team who's actually listening to customers. See how they're all connecting now? And then finally, learning and growth. How is your team being retained? Are they qualified team? How do we retain those quality staff? Right? Because if you don't have quality staff, you can't achieve your internal process. You can't keep your customers happy, and therefore you can't drive your financial. And if you don't have financial, then you don't have the resources to drive your learning and growth in your internal process. See, it's all connected, right? So basically, how this relates to an exam question is you might be asked to prepare a draft balance scorecard, or you might be given a draft balance scorecard that's already completed, and you might be asked to comment on this. Okay, so let's pull up one of the past year's exams, and we'll have a look at the one of the example questions relating to scorecards. So this one's from the MAAF 220 main exam, which is from the 2020 year. So question 1B, they actually give us a draft balance scorecard. See how below they've got the 4 categories here: financial, customer, internal processes, learning and growth. And they've got an objective for each. So number 1, grow revenue in 2021 by 40%. Customer service to be consistently high to encourage customer loyalty. Grow customer numbers through extensive marketing, retain knowledgeable staff. KPIs is revenue, percentage of repeat customers, number of new leads converted to customers, employee turnover. You got the units and the frequency of monitoring. So that's not to say this is perfect or even correct, but what this question is asking us to do, or that just give you an idea of what the structure would look like. What this question is asking us to do is actually to evaluate the balance scorecard above and provide 4 evaluation points. So we actually have to find out what's wrong with that table, using our knowledge of KPIs and objectives and what's the correct way of actually laying it out. So let's have a quick look at the exam solutions, because this isn't an exam prep video. I only want to quickly look at it because I want to focus on the core content. So let's see. So they're saying the solutions are draft balance scorecard lacks diversity because they're all measuring the same thing: revenue, customer growth. B, financial. So 40% growth target might be ambitious. Just keep them side by side. So for customers, measuring the percentage of customers yearly is too infrequently. Okay, so it's not, realistic or effective. A high percentage of repeat customers doesn't necessarily reflect good customer service levels. Right. So we want customer satisfaction, not just repeat customers. Internal processes, the objective is not smart in that it's not specific. Grow customer numbers through extensive marketing. Yes, it's a very broad objective, right? So it doesn't specify an appropriate metric for growth in customer numbers, e.g. in percentage terms or absolute number terms. The associated KPI does not relate to the objective, e.g. no linking to marketing expenses. Yes, it's just saying number of new leads converted to customers. That's still got nothing to do with marketing. The objective is in line with OTA's objective of rolling out new extensive campaign. Learning and growth. Low employee turnover could be linked to high customer service levels. The The objective is to retain knowledgeable staff. Unclear who would be the knowledgeable staff is, and employer turnover may not be linked to the knowledgeable staff. Employee turnover is a measure that would flag the problem too late. Yes, the very left at that stage. Okay, so I don't want to go into too much detail there. I just want to give you like a rough idea as to what a balanced scorecard might actually look like. What's an example question that you might get in relation to a financial scorecard? Sorry, a balanced scorecard. Okay, so let's keep deep diving into each of these categories. So financial. So it's generally focusing on profit and return on investment to shareholders. So it should include measures including the short-term and long-term financial goals of the organization. So ways to improve profitability is increase revenue through existing and new customers, decrease both direct and indirect expenses, better utilize assets through working capital and PPE effectiveness. Examples of KPIs commonly found in the financial perspective include profit per month, sales revenue per month, gross margin per month, ROI per annum. Develop and apply the balanced scorecard performance management model. So customer perspective measures should reflect the organization's goals relating to customers and the markets it operates in. These measures can relate to any or all of the following aspects: so customer satisfaction, retention, acquisition, profitability, market share, individual customer share of sales. Examples of KPIs commonly found in the customer perspective include customer complaints per month, number of repeat customers per month, number of new customers per month, percentage of market share per quarter. Okay, the third bucket is internal process perspective. So this relates to the process design to ensure that the organization's strategy is implemented. It considers which processes are critical to the success of an organization. The key to having the right measures in this perspective, ensuring that they are measuring the process and not the outcome. The processes and their related KPIs are operational processes, e.g. the producing and delivery of goods and services to the customer, or directly impact on organizational efficiencies, including waste. B, customer management processes relate to gaining new customers, servicing existing customers, and growing customer sales, which differs from customer perspective as focus on the process rather than the outcome. C, innovation processes relate to the introduction of new products and new services, or the implementation of new processes. And then D, regulatory and social processes ensure an organization is complying with or exceeding its legal requirements, e.g. environmental rules, employment practices, community involvement, workplace health and safety, and so forth. And then the final bucket is this, learning and growth perspective. So this includes measures of employee skills, information systems, and organizational culture. So it tracks competencies, technology, organizational culture, future growth. So some examples, KPIs that may be found in this perspective is new products developed per quarter, because that's reflective of your R&D, new menu items per month, staff absenteeism per month, because that's a reflection of organizational culture. I find that most people probably, out of all the categories, learning and growth is probably the category that most people don't understand or misunderstand or apply something else. So you can just refer to this list down here and just choose one of these items as an example. Okay, so the final thing is develop and apply the balanced scorecard performance management model. So you have to link that scorecard measures to strategy. So to achieve a balanced scorecard, measures should clearly link to the organization's strategic objectives that have been developed through the strategic planning process. So a balanced scorecard is not a fixed document. As an organization's strategy evolves, so should its balanced scorecard. As outcomes are achieved, new measures should be added to the scorecard to ensure that it mirrors the plan to implement the organization's strategy. So I guess the most important takeaway from this is you don't do these independently of each other. So like you don't just do your financial goals. Like you don't just put in, I want to make $1 million revenue. I want to keep customers happy. I want to retain skilled staff and so forth. All of these buckets and what you put in those buckets needs to be prepared with the lens of organizational strategy. So your organizational strategy needs to come first. So I gave the example before of being a market leader in your particular industry by this year. And of course, your objective also needs to be, your strategy's objectives all need to be SMART as well. So you make sure you include your time period, make sure it's measurable, it's achievable, realistic, all that stuff. So once you've got that strategy, so if you want to be market leader, then you go, okay, what do I need to achieve that strategy? So, returning happy customers, retain skilled staff, having efficient processes and effective processes, etc. So implementing and managing performance using a balanced scorecard. So because the balanced scorecard has a mix of outcomes, You've got those different categories. And you've also got your lagging and your performance driven, or your leading and your lagging indicators. So looking at your future, current, and past ones as well. And of course, they should all link to the strategy. So they've got a bit of a diagram here, which covers off this point here. Again, you probably don't necessarily need it for your exam. You just need to understand what it is, what are the buckets, what is the example objectives and KPIs that you could include when you do this in an exam. But just for your general feedback, I'll quickly skim through this blue section here, which is the steps you'd follow. And I'm doing this more from the perspective of if you go out in the workplace, if you take a job doing management accounting, these are the things you'd probably want to understand rather than you need to know this for the exam. So first one is understand the organization's vision. Of course, that's important first because you need to link all of the buckets into the vision and strategy. Then you analyze the organization's strategy from the 4 perspectives. Say, okay, what's my strategy? If it's to be the market leader, what do I need to do from a customer perspective? What do I need to do from an L&D perspective? What do I need to do from a financial perspective? Do I need an ROI? Do I need an IRR of above 15%? And so forth. Then you construct a strategy map to reinforce the links between measures. This is more so that when you're filling out a bucket, you don't just put something in isolation that doesn't make sense within the strategy. They all need to link, and they all need to link back to the strategy. For each of them, you need to establish performance targets and action plans. And if you've done a KPI, then, and as we mentioned before in this question over here in this past exam paper, see how for each of these they've got an objective, they've got a KPI, they've got a unit of measurement, they've got a frequency of monitoring, right? So that's making sure that you've got your target and your action plan to achieve it. Then you communicate it. Again, that's not going to be in the exam. This is just more for if you're in an organization. It's very important to communicate everything you're doing. It needs to be top down and show everyone's involved for a successful implementation. Then it's collect and analyze scorecard data. Well, that's important for if you're setting a KPI, you need to be able to collect the data so you can analyze it afterwards. Then you reward achievement. So if the performance remuneration is linked to the balanced scorecard results, then the achievement will be calculated, employee remuneration calculated accordingly. This is just a way of actually encouraging the chance that your strategy and objectives will actually be achieved. And we'll talk about it in the 4th subtopic later on, is the psychological effect of remuneration in employees. Then, of course, with anything that we do, any objective, any strategy, any KPI, there always needs to be the part at the end, which is most often missed in the real world, is you need to circle back. You need to come back and assess it. How did we go? What's the feedback? What can we do better next time? You need to track it as well. And then finally, revisit and update the balanced scorecard. So go back and change, because your company's strategic objectives change over time, your success factors change over time, and the balanced scorecard needs to be updated over time as well. Just one more time, you probably don't need this for the exam, it's just for your own benefit. Okay, so adjusting the balanced scorecard for government and not-for-profits. So these are more for a corporate, private enterprise. It's a little bit different in the government or not-for-profits because they don't have that financial incentive or requirement to be profitable as you do for a private enterprise. So what it's saying here in the MAAF module is that if you're doing a balanced scorecard for an entity which doesn't have that profit incentive, then you need to slightly adapt it. So for government, you must present a case to attract funding. For a not-for-profit, you need to attract funding from sponsors or donors and so forth. And it's just saying here that both of them view the financial perspective a little bit differently to private enterprise, including focusing on maximizing profit and return to shareholders. The financial perspective focuses on constraints rather than outcomes. So, we have this much funding from the government, we can do this much within our funding, rather than we need to grow revenue by 20%. It's more about what can we do with our money. B, focuses on not on profits as there are limitations in spending. So it's more about outcomes rather than, margins or profit growth or revenue growth. It's just outcomes within the constraints. And then C, it's important to include non-financial measures to assess performance. Again, because you're coming back and focusing on outcomes. If you're a charity, what have you achieved with that money? How many children have you fed and so forth. Okay, now we're on to the 4th subtopic, the last subtopic of this chapter, which is explain the impact of remuneration packages and performance measurement on behavior, motivation, and decision-making of staff. So the first thing is performance evaluation systems, which we talked about at the very top. So these are the systems, just to remind you, they're the systems used to align the performance goals of the employees, organization together. All right, we mentioned that. So remember back for example, the annual review process for staff at PwC. Now, how might PwC incentivize its staff to achieve its performance evaluation systems and achieve that highest rating? Well, staff might be motivated by just the desire to be good employees, do well. But for the majority of people, that's not enough. The majority of people are incentivized by other things, including financial, monetary incentives. And this is what this topic is going to be talking about. It's very common for companies to motivate their staff with money, but that can also have some unintended consequences, because some people are so motivated by money that they will do things that were unintended consequences. They might game the system, they might cheat, they might do things that are legal and maybe even not unethical, but it blends the lines of what is unethical. So I mentioned before kitchen sinking, which is the concept of if a CEO has 2 average years and he's going to receive a bonus, but he'll only receive a bonus in a year of high growth, or if the company does really well. What he'll do is he'll actually be incentivized to put all of his profits in this year and tank year 2. And he might do that through adjustments of accruals. He might encourage customers to bring forward revenue by giving them discounts. He might pressure staff to put sales contracts in this year, even though they're in this year. And what that might happen is it might actually damage the company in the long term. And also, if you're going to have a decline in profit the next year, maybe your share price might decline. Maybe customers will feel, pressured and then leave. Maybe they might be investigated by the auditors. They might have impact on those adjustments and so forth. So there's all these unintended consequences. So it's important to understand people's psychology and their incentives and what motivates them. So let's keep going with the textbook. So employees need to be measured on the achievement of multiple objectives for 2 reasons. 1, employees will be encouraged to balance their work as opposed to focusing on just one aspect of the detriment of others. 2, employee behavior can be more effectively managed to achieve the organization's strategic goals. So, use of multiple measures to assess performance. For example, ignoring safety measures in order to achieve certain targets. When a performance evaluation system is used to measure and reward performance, it's important to consider not only the desired behaviors, but also contemplate and monitor any unexpected outcomes. So this is what I was talking about before with kitchen sinking, and if you're thinking about what the CEO's motivation is or the staff's motivation is, you can think about what they might actually do to achieve that outcome and what they might do which is an unintended consequences or might actually cause more damage than if the employee had actually achieved their outcome. So a very common way companies reward performance is via remuneration or incentive schemes. It's very common. So the transparency between performance measurement and remuneration or reward is very important. So for the employee, it's important so that they understand how they will be recognized. For the organization, it's so that there is an alignment to the desired behaviors and outcomes. Potentially for shareholders, so that they can assess the remuneration of executives compared to the market and their performance as well. Okay, so the types of remuneration systems. So merit pay. So this is annual pay increases linked to a performance appraisal ratings. For example, at PwC, you get a 5 out of 5, you get a slightly higher pay increase, you might get 4% as opposed to 2%. Individual incentive pay. So this is rewards individual in performance. A difference from merit-based pay in that payments are not rolled into base pay. Performance is usually measured as physical output rather than subjective ratings. For example, you might get $1,000 gift card for doing really well that year. It's not going to be in your base pay. You're not going to get it necessarily next year. It might be just a one-off thing. Profit sharing. So this is payments based on a measurement of organizational performance. Payments do not become part of the base salary. Encourages employees to think more like owners. So for example, it might be a bonus, but the bonus is based on profit. So, if the company beats profit by targets by 10%, each employees get 1% of that additional amount or so forth. And it encourages employees to think like owners of the business, which is mutually beneficial because people will start, they might work harder. If they see, costs which shouldn't be there, they might help identify those costs, cut them out. Whereas if they're just getting a fixed salary, they'll be like, I don't care, it's not my problem. Ownership, so offering employees shares or share options. So there's equity schemes and things like that. So the employees will also be motivated by seeing that share price increase if they own equity. So they're more likely to act in ways that benefit the organization as a whole. Gain sharing, group incentives, and teams awards. So this is where you don't just reward a single employee, you reward a group's employees. So it's a way of incentivizing a team, and it's a way of preventing, I guess, individual team members from acting in a way which might create a culture of competition or cutthroat or not niceness. Whereas if it's a team, you get the team working together, creates a better working environment and so forth. So there's an unintended consequence of that. Okay, and then finally, skills based. So it rewards employees when new skills and capabilities are required. For example, if you're working at a professional accounting firm and you're not a CA, maybe after you get your CA qualifications, you might get a pay increase as a result of that. Cool. That is the end of Chapter 4, Measurements, Performance Measures. Just to quickly recap the chapter, we talked about performance evaluation systems, for example, your annual appraisal system. We talked about KPIs, why they're important, why it's really important to have a SMART approach, and we went through some past exam questions just so you can kind of get an idea as to what a good KPI is and what a bad KPI is. Number 3, develop and apply the balanced scorecard. So we went through some example scorecards, what it is, why it's important to focus it and link it to strategy always. And we went through a example question for that. And number 4, we talked about remuneration packages and why it's so important, not only as a means of motivating staff, but also understanding that your intention as a company can result in a different outcome to what you were expecting, and it's important to understand that and choose the appropriate remuneration package depending on the situation. So that concludes Unit 4. I look forward to seeing you in the next video, and thank you for watching.